Look at the latest news, and I mean, the consistently falling trend for QuantumScape.
Hmm.
If you're watching the market right now, you are seeing sell signals flashing everywhere.
Oh, absolutely everywhere.
Right. And you've got a stock price that has been just absolutely battered down to its 52-week lows. So the question we have to tackle today is pretty binary. Is this pre-revenue, solid-state battery company just a massive value trap? Or, is it secretly undervalued and sitting at the bottom of the cycle just waiting for a massive breakout?
That is the million-dollar question, isn't it?
It really is. Welcome to the deep dive. We are going to unpack the market data, the technical realities, and the upcoming earnings expectation to figure out what is really going on with QuantumScape stock. But first, quick housekeeping.
Yep, gotta pay the bills.
Exactly. You know the drill. Please like the video, subscribe to our YouTube channel, and it's absolutely compulsory that you leave us a comment with your feedback. We want to hear what you think about this stock.
And before we dig into the numbers, just a really quick disclaimer. The conversation we are having today is a natural human debate for educational purposes only.
Right. No financial advice here.
Exactly. Absolutely no financial advice is being given. You always have to do your own research.
Okay, let's unpack this. We have to start with the cold, hard reality of the stock's current price action, right?
Yeah, and it is pretty cold.
It is freezing. So, as of yesterday's close, this is April 21st, 2026, QuantumScape, ticker symbol QS, is sitting at $6.98 a share.
Which was down, what, about 2.79% just on the day?
Yeah, exactly. Down almost 3% on the day. But the longer-term trend is where the real damage is super visible. The stock is down 42.5% year-to-date.
Wow, that is a brutal chart to look at.
Right. It is trading dangerously close to its 52-week low of $3.65. And that's just a staggering drop when you consider the 52-week high was $19.07.
Yeah, the fall from $19 is steep.
It's like a leaky balloon, right? Slowly deflating over the year. So when a stock loses almost half its value in 4 months, are we looking at a market overreaction? Or is the market pricing in a fundamental flaw?
Well, the market is incredibly efficient at punishing pre-revenue companies, especially when the cost of capital remains this high. From a technical standpoint, trading near a 52-week low creates a sort of, well, a unique psychological gravity.
What do you mean by psychological gravity?
Well, investors anchor to that previous $19 level, right? And they just assume the equity is fundamentally cheap now. But the technicals actually tell a much more precarious story.
Okay, lay out the technicals for us.
So we are looking at a critical support level right near $5.90. If the price action breaks below that floor, and there is very little structural support catching it.
So it could just free fall.
Basically, yeah. There's nothing really catching it until it tests that absolute bottom of $3.65 again. And any meaningful recovery faces really heavy resistance at $7.59.
And what about the longer-term momentum?
The 200-day moving average, which dictates that long-term momentum trend, is way up at $10.43.
Man, the gap between the current $6.98 and that $10.43 moving average is just massive.
It's a huge mountain to climb.
It is. So to understand why the market is holding this stock down so aggressively, we have to look under the hood. We need to look at what QuantumScape is actually trying to build and, why it's burning so much cash to do it.
Right, because the financials for Q1 2026 paint a very specific picture.
They really do. It's the picture of a company entirely in the development phase. Analysts are expecting revenue for Q1 to be roughly $1 million. Or realistically, absolutely zero.
Zero is probably the safer bet there.
Yeah. And they're expecting an adjusted earnings per share loss of 18 cents. To put that in perspective, their net income loss for all of 2025 was $435 million.
And that burn rate is the crux of the entire valuation debate. I mean, QuantumScape is attempting something completely unprecedented in materials science.
You're talking about the solid-state battery tech.
Exactly. Traditional lithium-ion batteries use a liquid electrolyte and a graphite anode. But QuantumScape is trying to commercialize a battery with a pure lithium metal anode and a proprietary solid ceramic separator.
Which sounds amazing if they can pull it off.
Oh, if it works, it's revolutionary. You get vastly higher energy density, incredibly fast charge times, and, none of the fire risks associated with liquid electrolytes.
But there is a catch, obviously.
Always a catch. Manufacturing that ceramic separator at a massive defect-free scale is notoriously difficult. It's really, really hard.
Which explains their 2026 capital expenditure guidance. They are projecting between $40 million and $60 million in CapEx, specifically focused on their Eagle production line.
Right, the Eagle line is everything for them right now.
Yeah, they do have a total cash runway of roughly $970 million on the balance sheet right now, which, almost $1 billion sounds like an impenetrable fortress of cash.
It does sound like a lot of money.
But when your annual burn rate exceeds $400 million, that runway suddenly looks very short.
Yeah. If we connect this to the bigger picture, I look at QuantumScape's current R&D and CapEx burn like an experimental fusion reactor.
A fusion reactor. Okay, I like that.
Yeah, think about it. It requires an astronomical amount of initial energy, in this case, cash, just to initiate the reaction and keep the plasma contained.
Right.
And if you run out of energy before the reactor achieves sustained ignition, the entire system collapses, and you are just left with a very expensive, very useless facility.
So the cash is just fuel for the reactor.
Exactly. That $970 million cash position is the energy keeping the reactor running, and the Eagle line is their attempt to finally reach commercial ignition.
But let me play devil's advocate here. It's easy to have a strong balance sheet when you just raised a ton of money, right?
Right.
But with almost zero cash flow coming in, isn't this just a very expensive science experiment right now?
That is exactly what the bears are arguing. They aren't just building a standard assembly line. They are trying to prove they can scale atomic-level precision manufacturing to meet the insane volume demands of global automotive partners.
The pressure on that Eagle line is just immense because, like you said, if they hit a single manufacturing bottleneck with those ceramic separators on the Eagle line, that 2-year cash runway evaporates.
Poof, gone.
Yeah, they will be forced back to the capital markets to raise more funds at exactly the moment their stock is getting absolutely hammered.
And that vulnerability is precisely what attracts the momentum traders and the short sellers.
Right, because the fundamentals are basically untethered from current earnings.
Exactly. It makes the stock highly reactive to sentiment shifts. Short sellers aren't trading the company's current cash flows because there aren't any. They're trading the probability of QuantumScape hitting a scaling roadblock.
And the technical indicators really reflect that exact tension. The 14-day Relative Strength Index, the RSI, is showing neutral to slightly oversold conditions.
Which usually indicates it's beaten down but maybe stabilizing?
Maybe.
Yeah.
But the overall technical rating given by chartists is a weak 3 out of 10. But here's where it gets really interesting. The most critical metric hidden in the data right now is the short interest.
Oh, yeah. The short interest is wild.
It is sitting at a massive 18.96% of the float. Almost a fifth of all available shares are actively betting against the company's survival.
That is a staggering amount of negative pressure.
It really is. So is QS a ticking time bomb for short sellers? With a short float that high, couldn't any scrap of good news trigger a massive short squeeze?
Yes, absolutely. And nearly 20% short interest creates a deeply unstable equilibrium.
Because they have to buy the shares back eventually.
Right. Those short sellers are holding highly leveraged positions. They are assuming that the $400 million annual burn rate will outpace the technology's development.
But if they are wrong,
if QuantumScape suddenly releases unexpected positive news, say, an automotive partner officially validating their latest prototype cells, the price action will be violent.
so high short interest makes the stock incredibly susceptible to wild volatility spikes.
Exactly. Even if the long-term trend remains firmly bearish, the short sellers act as a coiled spring pressing down on the valuation. If it snaps, it explodes upward.
But right now, the smart money, the analysts and insiders, they seem heavily aligned with the short sellers. Wall Street analyst consensus is aggressively neutral to negative.
What are the exact readings right now?
There are currently 0 buy ratings on the stock. 0. We are looking at 7 holds and 2 sells.
That is a definitively negative signal for retail investors seeking any kind of confidence.
Right. And combine that with insider activity, and the picture looks even bleaker. Both the chief financial officer and the chief technology officer sold shares in early April 2026.
Now, to be fair, these sales were executed under pre-planned 10b5-1 programs.
I know. But the optics are still terrible.
This raises an important question, though, about how to interpret insider sales. Retail investors often struggle with these 10b5-1 programs.
Yeah, because it just looks like they are dumping stock.
Right, but executives set these automated sales schedules months, sometimes years, in advance to diversify their holdings or cover tax obligations. It isn't necessarily a panic sell signal.
I hear that. I understand the pre-planned nature of the structure. But let me push back on that. Even if it's pre-planned, Executives have the legal authority to cancel those plans if they believe the equity is severely mispriced to the downside, right?
They do have that right, yes.
So if the CTO genuinely believed the Eagle Line was on the verge of a massive commercial breakthrough, something that would send the stock surging from $6 back up to 19, wouldn't they have canceled those automated sales?
That is a very, very fair point.
I mean, they allowed those sales to execute at a 52-week low. That tells the market they're comfortable parting with their equity at this heavily depressed valuation.
The refusal to cancel those automated sales is definitely a crucial data point. It suggests that internal management understands the timeline to actual revenue-generating commercialization is still painfully long.
They know it's a grind.
They know the current valuation reflects the grueling, capital-intensive reality of battery manufacturing. And this lack of institutional buys and the steady insider selling forces retail traders to confront the ultimate debate.
Is it a value trap or an undervalued diamond in the rough?
Exactly. Is the long-term potential really worth the short-term pain?
Let's lay out both sides of that debate objectively, starting with the bull case.
Yeah.
The bulls look at the massive price drop in 2026 and see a severely undervalued asset.
Right, they see a discount.
Yeah. The core thesis relies entirely on QuantumScape successfully ramping up the Eagle Line and securing their first commercial licensing deals with major auto partners by maybe 2027 or 2028.
And if they achieve that, solid-state batteries basically become the new industry standard.
Exactly. And buying in at roughly $7 a share will look historically cheap in hindsight.
The bull case is essentially purchasing a call option on the year 2028. You are betting that the engineering team can solve the manufacturing bottlenecks before the CFO runs out of cash.
Right. But then there's the bear case. And this focuses on the structural damage happening to the equity while you wait for that 2028 target.
The bears highlight the persistent operational losses, obviously, but their primary focus is the mechanism of dilution.
Yeah, the downside risk of dilution is massive here. The share count is actually up 70% since the company's merger.
Wow, 70%.
That is a staggering expansion of the float.
This is why retail traders often get trapped in these specific scenarios. An investor looks at the chart, sees the historical high of $19, sees the current price of $6.98, and assumes they are buying the dip.
They think it's just cheap.
Right. What they fail to account for is how companies with no revenue actually survive. They survive by constantly issuing new shares to raise the capital required to keep the lights on.
It's the pizza dilution analogy.
Oh, I love this analogy. Go ahead.
So you buy a slice of pizza, right? Thinking you found a massive, thick piece for a bargain price. But as you walk back to your table, the chef continuously runs over and slices your piece thinner and thinner to hand out to new investors who are funding the restaurant.
Just slicing away your equity.
Exactly.
Yeah.
By the time you finally sit down to eat your slice in 2028, it is so paper thin there are basically 0 calories left in it. You still own one slice in name, but the fundamental value of your ownership has been entirely eroded by the constant expansion of the total supply.
That is spot on. Continuous share dilution quietly destroys equity value, even if the underlying technology eventually succeeds.
That's the crazy part.
It is. You could be entirely correct about QuantumScape revolutionizing the battery industry by 2028 and still lose money on the stock because your percentage ownership was diluted into oblivion over the intervening years.
Right.
The structural reality of capital markets is that high R&D costs demand constant funding, and that funding usually comes straight out of the pockets of early retail shareholders.
But all of these long-term macro theories, the 2028 bull case, the dilution bear case, the pressure from the short sellers, all of it is colliding with immediate reality tonight.
Oh yes, the short-term catalyst.
Today's April 22nd, 2026. After the market closes tonight, QuantumScape releases its Q1 2026 earnings report, and that is going to be followed by a critical webcast at 5:00 p.m. Eastern Time.
That webcast is going to be heavily scrutinized.
Absolutely. The critical focus of this webcast is management's update on their sample shipments to automotive partners. This is where the theoretical science meets the brutal reality of the automotive supply chain.
The automotive qualification cycle is notoriously unforgiving. I mean, battery companies have to deliver A samples first, which are essentially just functional prototypes.
Right, lab tests, basically.
Yeah, but then they have to deliver B samples. And B samples are functional prototypes built on the actual production line that will manufacture the final product.
Which is the Eagle Line for QuantumScape.
Exactly. QuantumScape is under immense pressure to prove the Eagle Line can reliably produce these B samples at volume without defects.
And the market knows the Q1 revenue will be 0 tonight. the market knows the earnings per share will be a loss. So the financial metrics are entirely secondary tonight. So what does this all mean?
It means the market is listening for a single data point tonight. Timeline validation.
Are the sample shipments to their automotive partners on schedule? And are the initial testing results from those OEMs positive?
Right, and if management shows any hesitation, like any at all, or announces any delays regarding the performance or output of the Eagle line, the market will severely punish the stock.
That $5.90 support level will likely just shatter.
It would break instantly. Conversely, if management announces that an automotive partner has officially validated their B samples and is moving toward deeper integration.
Then that 18.96% short interest becomes explosive.
Exactly. A definitive positive update on commercialization timelines is the exact spark required to trigger a forced buying feedback loop among those short sellers. A massive squeeze.
Yeah. However, it is vital for investors to separate short-term market mechanics from long-term business fundamentals.
Because even if it squeezes, the business hasn't magically changed.
Exactly. Even if the stock rips upward 20% tomorrow morning on positive sample news, commercial profitability remains years away. The fundamental reality of burning hundreds of millions of dollars annually to scale a new technology does not change overnight.
So let's briefly recap the incredibly precarious position QuantumScape occupies right now. We are evaluating a pre-revenue technology company sitting on nearly $1 billion in cash.
But burning through it very quickly.
Right. High burn rate to build an unprecedented manufacturing line. They are facing massive ongoing shareholder dilution. The stock is hovering perilously near its 52-week lows. The float is heavily shorted.
Analysts have completely stepped away with zero buy ratings.
Yep. And company executives are allowing their automated stock sales to execute at the bottom of the chart. Everything, literally everything, hinges on the narrative delivered during the earnings webcast tonight at 5:00 p.m. When analyzing a situation with this much binary risk, you just have to be brutally honest about your own capital allocation strategy.
What do you mean by that?
Well, think about it. If a company's fundamental value is entirely based on technology that won't see actual commercial licensing until 2028, are you investing in a business tonight, or are you just buying a very expensive lottery ticket?
That is a heavy thought, and that is the ultimate question for anyone watching this stock right now. Thank you for joining us on this deep dive into the mechanics and market realities of QuantumScape. Remember to like, subscribe, and leave your thoughts in the comments before the market opens tomorrow. We will catch you on the next one.